If you're studying accounting and finance, you might have come across the word budgeting. Budgeting is part of management accounting. However, how do we verify if budgets are efficient? And most importantly, what is the term flexed budget? A budget is a forward-looking exercise for businesses in general. Example, a budget could be prepared for a period of 1 year or more, and at the end of the 1 year period, actual results are compared against the budgeted results. Let's look at an example. Imagine we have drawn a budget at 4,000 units, and our actual results for the year is 6,000 units. We have raw material costs, labor costs, and fixed costs. Fixed costs by nature would remain fixed in the business. However, I'm more interested at looking at raw material, which is a variable cost. Now, at 4,000 units, raw material cost is $12,000. Labor cost is $8,000. And looking at the actual results for the year, which means at 6,000 units, raw material cost is $14,000, while labor cost is $9,800. Now, if you are the CEO of this company, you might think, well, the actual result, looking at raw materials, $4,000 is higher than the budgeted results at $12,000. So the difference between $14,000 and $12,000 gives you an adverse variance of $2,000. Looking at labor cost, at 4,000 units, labor cost was $8,000 and the actual results was $9,800. Again, the actual cost was higher than the budgeted cost by $1,800, which means this is an adverse variance. So the million-dollar question is, should the production manager be fired? Now, most of you would have the tendency of saying yes, because the actual cost was higher than the original budget. But the problem here is we're not comparing like with like. The budget was drawn on 4,000 units, while the actual results is based on 6,000 units. So it is important when we compare actual results and budgeted results that we compare like with like. There are two questions which needs to be asked. Major questions which need to be asked are: what should happen and what did happen? This is because when you ask those two questions, you would be able to compare like with like and make the analysis. But what exactly does that mean? Let's analyze the budgeted and actual results again. Okay, let's look at our original example and try to shed some light by asking the two famous questions: what should happen and what did happen. Let's look at the original budget, which means we are working with 4,000 units. Looking at raw materials, which cost $12,000 from the budgeting exercise, we can now calculate the material cost per unit simply by taking the $12,000 divided by the 4,000 units. If we do this, we get an answer of $3 per unit. Now, from this information, we can calculate what should the cost of raw materials be by applying it to the actual results of 6,000 units. We know material costs should be $3 per unit. We multiply by 6,000 units and we have an answer of $18,000, which means it should cost $18,000 when it comes to material cost. But hang on a sec, what did we find out? We found out that the actual material cost was $14,000. So, was this really bad for the company? Let's have a look further. It should cost $18,000, but it did cost only $14,000. So the cost was lower, which means that it is not an adverse variance. It is actually very good for the business because the business has saved $4,000 when it comes to raw material cost. In management accounting term, we call that a favorable variance. Let's look at the same example, but this time looking at labor cost. Now, from the original budget, which means at 4,000 units, we had a labor cost of $8,000. Using the same principle, we can calculate the labor cost per unit. All we need to do is we take $8,000 and divide by 4,000 units, which means the labor cost per unit is $2. Now, using this information to the actual results, which means the actual units of 6,000, the labor cost should be, well, $2 multiplied by 6,000 units, giving us a labor cost of $12,000. Remember, this is what labor should cost. But what it actually cost, it actually cost the company $9,800. Was this really bad for the company? Again, let's analyze further. The cost, by that I mean the labor cost, should be $12,000, but the actual cost was only $9,800. So really, this is a saving to the company of $2,200 when it comes to labor cost. So in fact, this is a favorable variance. Now, should the production manager of this company be fired? I don't think so. On the other hand, he or she probably deserves a promotion. So basically what we have done here, we have flexed the budget at 6,000 units to reflect the actual quantity to compare like with like. My name is Shaktee Ramtohul and I'm a lecturer in accounting and finance.